The global financial system, the world's biggest casino. Warning: the following content may completely change your perception of the world. Prepare to face raw truths and uncover secrets that those in power have tried their hardest to conceal. The information you're about to receive can not only alter the course of your life, but also give you an edge in this global financial game. Imagine a colossal casino, neon lights flashing, cheers echoing, and the sound of money pouring in endlessly. Brace yourself for a shocking truth. This casino is the global economic system we live in and depend on. From the moment you were born, you've been a pawn in this giant gambling machine. But there's a fatal flaw in this casino. The rules are set by a select few: big entrepreneurs, politicians, and financial tycoons at the top of the pyramid. They don't just create the rules. They ensure they always remain in an unbeatable position. Let's break down the 5 levels of this casino. Level 1. Big entrepreneurs, maintaining the current world order. Level 2. Startups, striving to change the world. Level 3. Hardworking employees with stable incomes. Level 4. Stock market investors, dreaming of wealth, but often reduced to speculating. Level 5. Lottery players, leaving their lives to chance. Which level are you at right now? Most people might find themselves at level 3 or lower. But remember, this isn't a fixed fate. By understanding how this system operates, you can break free from the mold and climb the social ladder. Before we dive deeper, don't forget to follow the channel for more insights about money and to help you achieve financial freedom quickly. Think Billionaires channel welcomes you all. Let's analyze some lesser-known rules of this game. These rules are like invisible chains, binding most people while creating endless opportunities for a select few. Rule number 1. The power of money making money. The wealthy can continuously accumulate wealth thanks to the power of compound interest. Albert Einstein once called compound interest the 8th wonder of the world, and that's no exaggeration. Simply put, compound interest is when your money generates more money, and that money, in turn, generates even more, creating a positive cycle. For example, suppose you start with $10,000 and your money grows at 10% per year through compound interest. After 30 years, you'd have over $200,000. But if you add $100 each month, after 30 years, you'd accumulate over $400,000. This is the core reason why the rich keep getting richer. But here's a harsh truth. Inflation is eroding your wealth. If your money doesn't grow faster than inflation, you're actually getting poorer in real terms. That's why keeping your money in a bank savings account is one of the worst ways to manage your finances. Rule number 2, risk and reward. In this financial casino, high rewards always come with high risks. But the truth is, top players know how to shift risks onto others while keeping the profits for themselves. The 2008 financial crisis is a classic example. Major investment banks orchestrated a massive scam. They created complex financial products, turning high-risk mortgages into investments that appeared safe and sold them to unsuspecting investors. When the bubble burst, these banks reaped massive profits, while ordinary investors and taxpayers bore the losses. Rule number 3. Information asymmetry. In this game, information is everything. Those at the top of the food chain always get critical information before everyone else. That's why, despite insider trading being illegal, it still happens in practice. Imagine this scenario. The CEO of a tech company leaks to a friend that the company is about to launch a revolutionary product. The friend quickly buys a large amount of stock, and when the news breaks, the stock price skyrockets. The friend easily makes millions of dollars. Meanwhile, ordinary investors can only watch and regret as the stock price surges, or they jump in at the peak just as the early investors sell off. Rule number 4. Leverage. Leverage is a double-edged sword. It can multiply your profits many times over, but can also leave you penniless in an instant. Financial elites are experts at using leverage, balancing risk and reward. For example, in real estate investing, savvy investors often use bank loans, leverage, to buy properties. Suppose you put down $200,000 to buy a $1 million house. If the house's value increases by 10%, your actual return is 50% because you only used $200,000 of your own money. However, be cautious. Leverage also amplifies losses. If the house's value drops by 20%, you not only lose your entire down payment, but also end up in debt. This is why using leverage requires extreme caution. Rule number 5, psychology in finance. The market isn't always rational because it's made up of humans, and humans are often driven by emotions. The two main emotions influencing the market are fear and greed. Smart investors know how to exploit this. For example, when the market crashes in a panic, they go against the trend to buy quality assets. When a market is overly optimistic, they take profits at the right time. Warren Buffett's famous quote, "Be greedy when others are fearful, and fearful when others are greedy," perfectly illustrates this principle. Understanding and controlling your emotions, while capitalizing on the emotional swings of others, is the key to success in the financial market. Breaking down the 5 levels of the global economic system. Level 1, big entrepreneurs. At the top of the pyramid, we don't just see successful business leaders, but also the rule makers of the entire economy. These big entrepreneurs wield enough resources and influence to dominate entire industries, even the global economic system itself. They don't just play the game, they constantly redefine its rules. Take Jeff Bezos, the founder of Amazon, for example. His business empire didn't just revolutionize the retail industry. It redefined modern business through technological innovation and continuous business model evolution. Amazon's lost to dominate strategy, sustaining long-term losses to capture market share, drove many traditional retailers out of business. This strategy might seem to benefit consumers, but in reality, it's a powerful way to monopolize the market. When Amazon faced accusations of monopolistic practices, they cleverly argued they were simply providing better services to consumers. This reasoning sounds logical, but masks a truth. By lowering prices and offering seemingly better services, Amazon is actually stifling competition, which could ultimately lead to fewer consumer choices and higher prices. The real secret of big entrepreneurs is their ability to socialize risks and privatize profits. When they make profits, those profits are entirely theirs. But when they face losses or crises, they can persuade governments to bail them out, leaving the public to bear the burden. The bank bailouts following the 2008 financial crisis are a prime example. Before the crisis, major banks chased profits recklessly, ignoring risks. But when the crisis hit, they claimed they were too big to fail and received bailout funds. Even more surprising, many large corporations actively lobby governments to enact regulations that favor them, blocking potential competitors from entering the market. This practice, often euphemistically called industry self-regulation, is really a way to stifle competition. They claim to protect consumer interests, but in reality, they're erecting legal barriers to safeguard their market dominance. This explains why some seemingly competitive industries are often dominated by a handful of big companies for extended periods. Big entrepreneurs are also skilled at shaping social trends. They control media, fund research institutes, and sponsor academic projects to steer public opinion on certain issues. For example, they might heavily promote the concept of corporate social responsibility, positioning themselves as defenders of societal good. However, these actions are sometimes just a means to secure tax breaks or improve their public image. Additionally, big entrepreneurs often have vast networks of relationships, including key figures in politics, business, and academia. These connections help them gain support during tough times and seize opportunities when the timing is right. Ordinary people might spend their entire lives unable to build such a powerful network. Finally, it's worth noting that this elite group typically has an exceptional ability to tolerate risk and a long-term vision. They're willing to accept significant short-term losses as long as they see substantial long-term profits. This mindset enables them to innovate boldly and invest, which is the key to maintaining their leading position. Take Elon Musk's Tesla, for example, which took bold risks to dominate the electric vehicle market. You'll understand. Level 2. Startup entrepreneurs. Startup entrepreneurs are often portrayed by the media as brave risk-takers and potential future big entrepreneurs. However, the reality of starting a business is far harsher than most imagine. According to numerous studies, over 90% of startups ultimately fail. So, how do successful entrepreneurs stand out? The truth is, many unicorn companies, startups valued at over $1 billion, are actually burning through investors' money. They use strategies like subsidies and discounts to rapidly capture market share. Their goal isn't profit, but rapid growth, aiming to exit at a high valuation. This is why you see companies that have never turned a profit valued at billions of dollars. Uber is a classic example. For years, Uber operated at a loss, yet its valuation kept rising. Why are investors willing to keep pouring money into a losing company? Because they believe Uber will dominate the ride-hailing market, allowing it to raise prices freely and reap massive profits later. This strategy is called winner takes all, meaning the final victor in a market will capture nearly all the profits. However, for most ordinary startup entrepreneurs, this strategy is incredibly risky. Without strong financial backing, most startups can't sustain prolonged losses. This is why so many startups fail early on. They might have great ideas but lack the capital to survive the initial loss-heavy phase. Startup entrepreneurs also face another harsh reality: the rapid pace of technological and market changes. An idea that seems innovative might become obsolete in just a few months due to new technology or business models. For example, franchising businesses were once a hot startup trend, but quickly declined due to excessive competition and management issues. Moreover, startup entrepreneurs face pressure from big corporations. When a startup shows potential, large corporations often jump in, leveraging their resources to dominate the market. For instance, when a new social media app feature gains popularity, major platforms quickly integrate that feature into their products, posing significant obstacles to the smaller company's growth. Despite this, startups remain a crucial driver of innovation and economic growth. Successful entrepreneurs often share key traits: sharp market awareness, the ability to learn and adapt quickly, excellent team management skills, and unwavering persistence. They can learn from failure, grow through adversity, and convince investors to believe in their vision. Level 3. Office workers. In the middle tier of the pyramid, we find the largest group: office workers. This group often sees themselves as society's backbone, believing that through hard work, they'll achieve a stable life. However, the reality shows they're running on a treadmill that keeps speeding up. The first challenge office workers face is persistent inflation. While their nominal salary might increase, their real purchasing power can decrease. Housing prices are soaring, making it difficult for many who've worked for years to afford a home in major cities. Rising education costs create anxiety about their children's future. These factors continuously erode the income and quality of life of the office worker class. Even more concerning, with the rapid development of artificial intelligence and automation, many traditional office jobs are at risk of being replaced. A report by the McKinsey Global Institute estimates that by 2030, up to 800 million jobs worldwide could be automated. This means that those who think their jobs are stable might soon find their skills outdated. For example, in finance, many analyst and trader roles have been replaced by algorithms and AI systems. In law, AI is taking over tasks like document review and basic legal research. Even in medicine, AI diagnostic systems in some fields have surpassed the accuracy of doctors. The harsh reality is, in modern businesses, most employees are seen as replaceable resources. When companies need to cut costs, layoffs are often the first option. This is why the concept of lifetime employment has become a thing of the past. In this environment, office workers must continuously learn new skills and enhance their irreplaceable value to remain competitive in the job market. Office workers also struggle with balancing work and life. The rise of technology means work can follow them anywhere. Many find it hard to truly disconnect after work hours. Long hours, high pressure, and a lack of downtime not only affect physical and mental health, but can also strain family relationships. Additionally, the office worker class faces pressure from both sides. On one hand, they must compete with younger workers entering the market with updated skills and knowledge. On the other hand, climbing to higher management positions is difficult due to limited openings and fierce competition. Faced with these challenges, many office workers have started seeking side jobs or starting their own businesses, hoping to generate extra income and increase financial security. However, this brings new pressures and risks. Overall, the office worker class is living in an era of uncertainty and challenges. To remain competitive, they need to continuously learn, adapt to change, and find ways to balance work and life. Those who can face and overcome these challenges will find new opportunities, while those who can adapt risk being phased out. Level 4. Stock market investors. In the food chain of the financial world, stock market investors are often seen as easy prey, those repeatedly exploited and harmed. Though this metaphor may sound harsh, it's not entirely untrue. Most stock market investors think they're investing wisely, but in reality, they're betting in a massive casino. The rise and fall of the stock market often has little to do with the real value of companies, driven instead by complex factors. These include market sentiment, unexpected news, policy changes, and even malicious manipulation by large capital forces. In this world of information asymmetry, the average investor is usually the last to know the truth. Consider a staggering statistic. According to research from reputable organizations, over 95% of day traders end up losing money. This figure is shocking, but not surprising. Why is that? Because small-scale investors are essentially gambling against financial institutions with insider information, advanced high-frequency trading systems, and abundant resources. It's like a sheep trying to survive among a pack of wolves. The outcome is predictable. Worse still, many small-scale investors get caught in a vicious cycle known as buy high, sell low. When they see a stock continuously rising, they fear missing out and buy a high price. But when the price starts to fall, they panic at the prospect of losses and sell at a low price. This behavior is exactly what large institutions love, as they can exploit the fear of small-scale investors to buy low and later sell high to those driven by emotion. Many small-scale investors are also easily swayed by so-called insider information. They delude themselves into thinking that a few leaked tidbits will give them an edge in the market. However, real insider information rarely trickles down to the average investor. Most of the time, these rumors are just hearsay or deliberate distractions spread by large institutions. Another common trap is overconfidence. Some investors, after one or two successes, believe they've mastered the market's rules and start increasing their investments heavily, even borrowing to buy stocks. But they forget a simple truth. Short-term success might just be luck, not skill. Additionally, some investors put too much faith in technical analysis, spending hours studying price charts and indicators. They believe they can predict stock price trends through these charts, but they overlook a critical factor. Past performance doesn't guarantee future trends, especially in a market manipulated by large capital flows. So, are small-scale investors doomed to be easy prey? Not necessarily. The key is to change your mindset and investment strategy. First, understand that stock market investing is a long-term process. Don't expect quick profits from short-term trades. Second, learn to diversify risk. Don't put all your eggs in one basket. Third, continuously educate yourself to improve your financial knowledge and risk management skills. And finally, most importantly, recognize your limits. You may never outmatch institutional investors with their resource advantages, but you can collaborate with them. For example, by investing in high-quality index funds or actively managed funds to participate in the market. Remember, in the financial market, your greatest enemy is often not the market itself, but your own emotions. Control greed and fear. Maintain rationality and patience. And you can avoid being repeatedly exploited, becoming a wiser long-term investor. Level 5. Lottery players. At the bottom of the pyramid, we find a group that evokes sympathy. Lottery players. Lotteries are often called a fool's tax or tax on the poor. While this label may seem harsh, it's not without basis. Governments and lottery companies have cleverly exploited the dream of overnight riches to drain money from the poor. Let's look at the odds of winning a lottery. For example, one of the most popular lotteries in the U.S., Powerball, has odds of winning the jackpot at about 1 in 292 million. What does this number mean? Simply put, you're more likely to be struck by a meteorite or become the U.S. president than to win the lottery's grand prize. Despite this, millions of people buy lottery tickets every week. Why? For many, especially those in society's lower classes, the lottery might feel like their only chance to change their fate. In a world where social stratification is increasingly rigid and social mobility is declining, the lottery offers a faint, illusory hope. For just a small amount of money, I could change my life. This mindset, combined with humans' inherent misunderstanding of probability, makes lotteries an extremely effective tool for profiting off the vulnerable. But here's a harsh truth few realize. Even if you actually win the lottery jackpot, it might not be a good thing. Numerous studies show that many big lottery winners end up with a lower quality of life. Most of them, lacking financial management knowledge, quickly spend all the money. Some have their personalities changed by sudden wealth, alienating friends and family. Others face constant harassment from acquaintances, even extortion or threats. Even more shocking, some big winners end up in worse financial situations than before they won. They grow accustomed to a lavish lifestyle, but when the prize money runs out, they can't sustain it. Some even fall into heavy debt and declare bankruptcy. This is why we often hear stories of lives falling apart after winning the lottery. The lottery also carries another hidden risk. It can lead to gambling addiction. For some, buying lottery tickets might just be occasional entertainment. But for others, it can become a hard-to-break addiction. They might spend more and more money on tickets, deluding themselves that the next ticket will change their destiny. This behavior not only causes personal financial damage, but can also lead to serious psychological issues and family conflicts.